What if someone told you they could beat the market, but it would cost you 2% of your money every single year, plus 20% of any profits? Would you hand over your savings? That's the deal hedge funds offer. They manage trillions of dollars, attract the world's richest investors, and operate behind a veil of secrecy. Let's pull back the curtain. A mutual fund pools money from ordinary investors, buys a basket of stocks, and charges around 1% or less. A hedge fund does something very different. It uses leverage, short selling, and complex strategies to try to generate returns regardless of what the market does. Hedge funds are only open to accredited investors, people with a net worth over $1 million or income above $200,000 a year. This exemption from securities regulation gives them far more freedom in how they invest. So what strategies do these funds actually use? Long-short equity funds buy stocks they think will rise and short stocks they think will fall, trying to profit from the spread between winners and losers. Global macro funds bet on big economic trends, interest rate changes, currency movements, or commodity cycles. George Soros famously broke the Bank of England using this approach. Quantitative funds use mathematical models and algorithms to find patterns invisible to human traders. And event-driven funds profit from corporate events like mergers, bankruptcies, or restructurings. Now here's the part that matters most to your wallet, the fee structure. Hedge funds traditionally charge 2 and 20. That's a 2% management fee on all assets every single year, regardless of performance, plus a 20% performance fee on any profits. Let's walk through what this actually looks like. Say you invest $1 million and the fund earns a 10% gross return. That's $100,000. First, the management fee takes $20,000. Then the performance fee takes $16,000. 20% of the remaining $80,000 in profit. Your net return? Only $64,000, or 4%. That might not sound terrible in 1 year, but compounding makes it devastating. Let's simulate 20 years of investing $1 million at 8% gross annual returns. Watch how the fee drag compounds over time. After 20 years, the no-fee portfolio grows to $466 million. The index fund charging 0.1% reaches $456 million. But the hedge fund with 2 and 20, just $65 million. Fees consumed nearly $2 million of potential wealth. There's one protection for investors called the high watermark. If a fund loses money 1 year, the manager can't collect performance fees until they've recovered the losses. Think of it as a line. The fund has to get back above its previous peak before the 20% kicks in again. Hedge funds have achieved legendary status. Bridgewater Associates, founded by Ray Dalio, manages over $100 billion and pioneered risk parity. Renaissance Technologies, run by mathematician Jim Simons, has generated 66% annual returns in its Medallion Fund. And Citadel, led by Ken Griffin, is a market-making and multi-strategy powerhouse. But here's the uncomfortable truth. The average hedge fund has underperformed a simple S&P 500 index fund over the last 10 and 20-year periods. After fees, most investors would have been better off in a low-cost index fund. And it gets worse. The data suffers from survivorship bias. When a hedge fund blows up or shuts down, its terrible returns disappear from the databases. We only see the survivors, which makes the industry look better than it actually is. If that's the case, when does a hedge fund actually make sense? For the ultra-wealthy, hedge funds can provide real diversification, returns that don't correlate with the stock market. In a crash, that non-correlation can be worth every penny of fees. Tax-exempt institutions like endowments also benefit because they can tolerate lockup periods and don't lose returns to capital gains taxes. Yale's endowment famously pioneered this approach under David Swensen. So, what are the key takeaways? First, hedge funds charge 2% management fees plus 20% of profits, and those fees compound dramatically over time. Second, most hedge funds underperform index funds after fees. The few that consistently beat the market are extremely hard to access. And third, for most investors, a low-cost index fund remains the smarter choice. Warren Buffett put it best when he bet $1 million that an S&P 500 index fund would beat a basket of hedge funds over 10 years. He won convincingly. The lesson? High fees are the surest way to turn above-average returns into below-average wealth.